Hey everyone, welcome to FinTech. So my stock portfolio is up over 30% for the past quarter, with some of my positions up over 50% from their lows earlier this year. And in this video, I'm going to be revealing my top 9 stocks to buy right now. These are all stocks that I hold in my portfolio, and I'll be giving my reasons for investing in them. So hit the like button if you want, and let's dive right into looking at my Charles Schwab stock portfolio and not waste any time. So I have pulled up on my computer here my actual stock portfolio, and you can see that over the past 3 months, it's increased by over 30%. But if we go to the year-to-date view, things aren't looking quite as good. Year-to-date, the portfolio is down around 30% as well. And that's because at the beginning of the year, we saw a huge sell-off between January and May of this year. And then since then, my portfolio has sort of recovered slowly since then. Now, this stock sell-off has affected everybody's portfolio, but it's affected mine more than others because I'm heavily invested in technology stocks, which were hit very hard at the start of the year. But if we go to a longer-term time horizon, let's say over the past 2 years, we can see that my portfolio is still up around 30% over that time period. And it's up even more if we were to expand a little bit longer. So the stocks I'm currently investing in are companies that I think have the best chance of having very positive returns going forward. And make sure to watch the whole video because I'll be going through every single position, starting with my lowest conviction positions and ending with my highest conviction positions that I think will have extremely high returns over the next several years. And one thing I should point out is that this number in Charles Schwab is a little bit of an overestimate because for some reason they count any money that you add to the account as a gain. So my actual gains are a little bit lower than this. So with that said, let's look at my individual stock positions. The smallest position that I'm currently investing in is SoFi, which I currently own 321 shares of at a value of just under $2,000. And that's off an initial investment of $4,000. So it's lost around half of its value during the time that I've owned it. And this is because of sort of a general sell-off in fintech stocks over the past year. SoFi is really 3 businesses in one. You have lending, technology platform, and financial services. Financial services is like the SoFi app and the SoFi checking and savings account. It's kind of the more public-facing part of the company. And they use this part of the company almost like a top of sales funnel to capture more users and then funnel them down to more valuable parts of the company like lending. SoFi actually started off as a student loan business, so their lending business really is their bread and butter. But over time, they've pivoted more into personal loans because of the moratorium on student loan payments. And so once that moratorium ends starting in 2023, SoFi should see a huge amount of growth in the profitability of their lending segment. This unique business model also lets SoFi outcompete competitors like Robinhood, which need to make a lot of money from their investing customers, because SoFi's investing customers don't really have to be profitable at all, since they make so much money on the back end by transferring their financial services customers into lending. Then of course there's SoFi's technology platform, which they're trying to build into the AWS of fintech, and I'm not going to dive into all the details there, but you can check out this video which I did on SoFi that explains that in more detail. Next up we have Upstart, which I currently own 124 shares of at a value of $3,000, and that's off an initial investment of nearly $28,000. So this is by far my worst performing position overall. Now what's weird is that even though this position has performed extremely poorly in terms of the stock price, Upstart as a company is still performing fairly well. Upstart offers AI lending services. So in a traditional lending platform, they'll look at one number to determine your creditworthiness, your credit score. But SoFi takes this one number and replaces it with thousands of different parameters that they feed into an AI model. And that AI model is much more accurate at predicting whether or not you're a credit risk. So they can either offer loans to people who wouldn't qualify for a traditional loan or offer better rates to people who would normally qualify under just their credit score. And the stock price has collapsed not due to the fact that this product doesn't work. It does, and they actually have data showing that they have better long-term outcomes for people who use their platform. The only problem is that the credit market kind of dried up over the last 2 years, and because Upstart's entire business model is to basically sell as many loans as possible, this hit their business pretty hard. Honestly, I don't think Upstart is going to recover in the short term as long as we're still in a recession and we're facing macroeconomic headwinds, but I do think that in the longer term, maybe 5 to 10 years, this company will perform extremely well once the economy turns around and fintechs in general start to recover. Now you may notice that a lot of these positions have this rating next to them, and this is just a rating that Charles Schwab gives. As far as I can tell, this rating is based as if these are value stocks because I've owned companies in the past such as Crowdstrike, which I made a 300% return on, which had an F or a D rating the entire time that I owned them. So I wouldn't put too much weight on Charles Schwab's rating on these stocks. It's just a different style of investing. My third smallest position is Sentinel One, which I own 274 shares shares of at a value of roughly $7,500. And don't worry, at the end of the video, I'm going to show you my entire stock portfolio chart with all the different company names filled in. So SentinelOne was originally an investment of just under $13,000, and it's lost around $5,000 during the sell-off this year. SentinelOne offers autonomous AI security, so it's almost like a super advanced antivirus software. In the past, in order to make antiviruses smarter and smarter over time, you would basically capture previous viruses and put them into a big database and just remember what they look like. Then you scan people's systems to see if there's a match on any of those viruses you've seen before. But SentinelOne AI allows it to look for patterns in viruses and detect those viruses before anybody else has even seen them before. And this is clearly working really well for SentinelOne, because if we look at their revenue over the last 4 quarters, a year ago they grew 128% in a quarter, then they grew 119%, then 109%, and in their most recent quarter they grew 124% year over year in terms of their revenue. As we continue to see more and more data breaches and large-scale hacks, companies are going to be looking for a cloud-native solution like SentinelOne, and we're already seeing them having this massive growth rate in their revenue, so I don't see them slowing down anytime soon. So now moving out of some of these smaller positions and into what I'm calling the mid-sized positions in my portfolio. The first mid-sized position we're going to look at is ZoomInfo, which I own 194 shares of at a value of $8,500, and that's down off an initial investment of just under $12,000. Now ZoomInfo is basically the marketing and sales platform of the future. If we go on their website, we can see they boast customers such as Google, Zoom, Snowflake, and T-Mobile. And they offer several different platforms including Sales OS, Marketing OS, Talent OS, and Operations OS. Basically, ZoomInfo started out as a sales platform where they could match up people who are looking for a product with people who are selling their product. So it benefited the salespeople because they could more easily reach the people they were selling to, but it also benefited the people on the other side because they were being reached out to people who actually can solve their problem. And then from there, ZoomInfo expanded into covering marketing as well, then also covering talent, and then also covering operations. And over time, they're sort of becoming the go-to source for all kinds of digital data that a company might be looking for. As you'll probably see as I go through my portfolio, data is one of the core trends that I'm following with these picks. And so as we see more and more data become available online, the real question companies need to ask is not how to find more data, but how to make sense of the data that's there. And ZoomInfo helps them do that. ZoomInfo is also performing very well in terms of growth. Their revenue has been growing at over 50% per year over the last 4 quarters, and actually even beyond that. So this is a company that's absolutely taking over the online space. Next up, we have Crowdstrike, which is actually a company I used to own around a year ago before selling out and then rebuying in a few months ago. Now Crowdstrike I currently own 52 shares of at a value of $8,800, and that's down a little bit off of the $10,000 initial investment. Now Crowdstrike offers a very similar solution to SentinelOne. They use AI to automatically detect data breaches before they actually happen, and Crowdstrike is really the leader in this space. Crowdstrike offers a fairly strong diversified set of products. Basically, they have the Crowdstrike Security Cloud with all kinds of products on top of that, including endpoint security, cloud security, threat intelligence, identity protection, and security and IT operations. Now, the original reason I sold out of Crowdstrike is because I saw their growth rate slowing from the high 70%, and about a year ago, they slowed their revenue growth rate to 63% growing over year, then 62, then 61, then 58. And so I was worried that this was a sign the company was slowing down and kind of losing their way. But then when I reevaluated, I realized that Crowdstrike was still growing extremely quickly. 60% growth year over year is absolutely insane. I was just spoiled by the 70% growth they'd had in the past, especially considering this is a company whose revenue is over $500 million per quarter. So that's $4 billion per year, and they're growing at over 50% a year. That is absolutely insane. Crowdstrike at this point is really able to hit some of those large enterprises that are moving into the cloud. And as more and more companies move into the cloud, they're going to need a cloud-native solution like Crowdstrike to protect them. Plus, as we're potentially in a recession for the next few quarters, the market leader tends to consolidate during a recession, which would be a good thing for Crowdstrike. So that's why Crowdstrike is my next largest position. Next up, we have Bill.com, which is a new stock in my portfolio this month. And anybody who's been following me on Patreon would have seen seen that update a few days ago. So Bill.com, I bought 74 shares of earlier this week at an initial value of around $12,000, and now I have around $11,000 in it. So it's down a tiny bit since I first bought it. Bill.com is essentially the bill payments platform for other businesses. So they're a B2B business, meaning they sell their services primarily to other businesses rather than consumers. This is a good thing because businesses are a lot less likely to cancel their contracts than a consumer are. So if we're in a recession, you'd rather be in a B2B business rather than a business to consumer business. Plus, we know Bill.com is extremely sticky with a net revenue retention rate of over 130% per year, meaning that every year a customer uses Bill.com, they can be expected to pay 30% more the next year because they like the services so much that they use more and more of it every year. The company is also growing their revenue faster than any other stock in this list. They grew their revenue 156% year over year a year ago, then 189%, 179%, and 155% in the most recent quarter. Now that did include some acquisitions, so it's not all organic, but even looking at just their organic revenue growth year over year, they're up over 70% over the past year. So this is a company that shows no signs of slowing down, and as we see more and more businesses decide to outsource more and more parts of the business to single vendors like Bill.com, they're going to benefit by that sort of secular wave toward cloud-based companies that can just handle the services for them. It's a lot cheaper to hire Bill.com than to build your entire own payments platform by yourself. Now after Bill.com, we get into the heavy hitters in the portfolio. My top 4 largest stock positions, which together make up around 75% of my overall portfolio, as you can see in this chart. So if you're looking for new stocks to invest in, this is probably where I would start my research. So the first stock we're going to look at is Cloudflare, which I own 317 shares of at a value of just under $19,000. And that's basically flat from the initial $20,000 that I invested in it. Now Charles Schwab is a little bit misleading here because they show that I have a loss in Cloudflare, but in reality, that's just because of the way they calculate losses is based on first in, first out. So I sold some of my Cloudflare that was at a profit and then bought in at a higher price. So Charles Schwab thinks that I've lost money, even though in total I've made a little bit of money in this stock. Now Cloudflare's goal is to make the internet itself work better. They started out as sort of a security company that offered firewall services, but they quickly expanded into covering all aspects that a website might need to operate, including performance. Cloudflare is probably the most innovative company that I have on my list overall, and if we just look at the sheer array of products that they offer, they cover application services, zero trust, network, developer platforms, analytics. Basically anything you need to launch your tech product or platform, Cloudflare can provide that to you. In fact, they've gotten to the point where they're actually competing with the big players like Amazon Web Services or Google Cloud or Microsoft Azure, which is something that would have been unthinkable 5 years ago. Of course, Cloudflare has also been growing basically rock steady for the last half a decade. If we look at their last 4 quarters, their revenue has grown by 50% every single quarter, and they've actually continued that trend going all the way back to around 2016. If you're interested in learning more about this company, I highly recommend checking out the Cloudflare blog, and specifically articles written by Matthew Prince, who's the CEO of the company. He's a really good writer, and he's really good at breaking down complex ideas into ways that are pretty easy to understand, even if you're not a tech nerd like me. My third largest position overall is Zscaler, which I own 112 shares of at a value of $19,000. And that's off an initial investment of $27,500. So it's also down a little bit from where I first invested in it. Now, Zscaler is also a security company, kind of like Crowdstrike, but they operate in a different area. While you can think of Crowdstrike like a super advanced antivirus, Zscaler is all about protecting enterprises. Now, in the traditional security model, you would set up a firewall around your company, and that would keep the bad guys on one side of the wall and all the good guys inside. The problem is, if a bad guy gets into the network, they basically had free reign to everything. Zscaler gets rid of this problem by using zero trust security, meaning every website, every person on the network, every individual application has to authenticate with everybody else before it's trusted. This is basically the default way that security is going to work as more and more companies move into the cloud, and Zscaler is really a leader in this space. As more and more companies begin to integrate their data between both their competitors as well as their partners, Zscaler is going to need to be around to protect that data and all those different integration points. And it's clearly working because Zscaler has been growing extremely quickly. Similar to Cloudflare, Zscaler has been growing rock steady for quite a while now. If we look back a year ago, they were growing 61% year over year. The next quarter, 62%. The next quarter, 62% again. And in their most recent quarter, they again grew 61% year over year. And that's while making revenue of over $300 million per quarter. So this is a company that makes over $1 billion in revenue per year, growing at 60% each year, meaning that if the stock price stays flat like it has over the last few months, the company is actually getting cheaper and cheaper every subsequent quarter relative to the earnings that they're bringing in. And something that's been a really positive sign to me is that Zscaler, after reporting their last earnings, saw their stock price jump by around 30% basically overnight before then selling back off again over the next few days. This to me tells me that the market is really underestimating some of these solid performing growth stocks that are growing at basically 60% every quarter. And so when they just report business as usual, the market is reacting very positively, which may be a sign that we're getting close to the end of this tech sell-off. Now we're moving into the two largest positions. First off, we have Snowflake, which I own 160 shares of at a value of $30,000, so nearly double the size of the next position. And that's off an initial investment of $29,000, so this one is slightly positive. And that's because Snowflake is a newer investment for me. Now Snowflake is a data company. They manage all aspects of a company's data. So the way I like to think about it is that 100 years ago, you had someone writing all their data on a physical notepad. Then all of that moved over into simple spreadsheets, kind of like Excel. Then that moved over into more advanced databases. Then that moved over into the cloud. Then you had data warehouses. And then Snowflake is the next step, representing an order of magnitude improvement over the previous step. And they call themselves the data cloud. Now, most people are aware that companies are generating more data than ever. But what you may not be aware of is that most companies don't know what to do with this data. Snowflake handles a lot of the complicated parts of dealing with the massive data a modern enterprise generates, and handles all the access, all of the native building that you need to do, as well as allowing you to collaborate with other companies in your area. So let's say I'm a pharmaceutical company, I can actually share a portion of my data with other pharmaceutical companies that are also on Snowflake, using something called a data edge. This makes it really easy for partners to collaborate on, say, a product that they're working on. And it also means it's really hard to leave Snowflake, because if you leave Snowflake, you lose access to that data from your partner and you have to build a whole new platform from scratch. Now, people have always known that Snowflake was going to take over the world eventually. One of the ways to measure how overvalued or undervalued a company is their price to sales ratio, which is essentially their market cap divided by their revenue. When Snowflake first IPO'd, they had a price to sales ratio of over 100, which is one of the highest I've ever seen. And their price to sales ratio stayed over 100 for several years after they first IPO'd. But then more recently, their price to sales ratio has begun dropping every subsequent quarter. And if we scroll all the way to where we are now, their price to sales ratio is currently sitting at 35, which is the lowest that I've ever seen it. This means that Snowflake, in my eyes, has gone from a completely overvalued stock that has incredibly high expectations that probably can't be met to a stock that at this point I think is undervalued relative to its growth. Look at it this way. If we look at Snowflake's revenue for the most recent quarter, Snowflake made around $500 million in revenue their last quarter, and they grew it at 82% year over year. So if you have a company that is doubling their revenue effectively every year, after 1 year, assuming their price to sales ratio doesn't change, the stock will be twice as valuable the next year. And if they double again, it will be twice as valuable again. Once you start to get to a low enough price to sales ratio that the price actually seems reasonable with these really high growth stocks, that means that there is essentially explosive growth available in front of it for the stock price. Now on the flip side, Snowflake's stock price could just stay the same at where it's at, but in that case, if their revenue is doubling every year, this price to sales ratio will drop in half and it'll go all the way down to 17. Then if they double again, it would drop all the way to 9, at which point they are very clearly undervalued even if they were a value stock. And so because of this, at this point, Snowflake is one of my highest conviction positions. But I said one of my highest conviction because my highest conviction position overall and my largest position overall is Datadog, which I owe 401 shares of at a value of $37,500, and that's off an initial investment of $35,000, so it's up around $2,000 overall. And in reality, I did sell some Datadog at a higher price and then bought more of it, so this is again a little bit underestimating how much I actually made in the stock. Now, Datadog, similar to Snowflake, is a data company, but they unite a company's applications, their infrastructure, and their security all through what they call a single pane of glass. They're making it really easy so that companies can actually see what is going on in the business based on their data. And even now, when we're in a recession, companies aren't canceling their Datadog services. In fact, they're spending more on Datadog every year. Datadog has a net revenue retention rate of over 130% per year, or an NRR. This means for every $100 a customer spends on Datadog, Datadog, Datadog knows they will spend $130 next year, just because that's the value that Datadog provides to their business. Datadog's in the sweet spot of selling to other businesses who are a lot less likely to cancel, while making those businesses more money than it costs them. So even in a recession, Datadog is in a very good spot to continue growing. And this is evidenced just by looking at their year-over-year revenue growth rate, which a year ago was up 75% year over year, then 83%, 82%, and up 74% in their most recent quarter. Datadog is honestly just a rock-solid performer. I never need to worry about it, and it just keeps on growing whether or not the market recognizes it. And I know that in the short term, the market is a voting machine, but in the long term, it's a weighing machine. And in the long term, the scales are going to tip toward these stocks that are fundamentally changing the way that businesses operate. And I said at the beginning of the video, I would show a chart that includes all my stock positions at once, so I'll flash that up on the screen here. And if you like these types of stock breakdowns, I do them twice a month on my Patreon. They're not going to give you any additional information that you won't eventually get here, but if you want to get that information a little bit earlier, as well as near real-time info on all the trades that I'm making, you can find it there. Don't forget to like and subscribe, and I'll see you next time.